Imagine you've just saved $50,000. It took you years. Maybe you cut back on things that mattered to you. Maybe you worked extra hours you didn't have. But it's there, sitting in your account, and for the first time in a long time, you feel like you have options. And then someone tells you to invest it. So you start researching. And within about 20 minutes you're completely overwhelmed, because half the internet is telling you to buy real estate, and the other half is telling you to put everything into index funds. Both sides sound convincing. Both sides have spreadsheets. Both sides have people who swear their way is the only way. And you're sitting there thinking, okay, but which one actually works? I'm Finn. And I've spent a lot of time thinking about this question. Not just the math, but the part nobody really talks about. The hidden cost. The time it takes. The psychological weight of each path. Because the numbers alone don't tell the full story, and I think that's where most of these comparisons fall short. So today we're going to do something a little different. We're going to run the real math. Not the glossy version, not the version designed to sell you a course. The version that actually reflects what it feels like to live inside both of these decisions for 20 years. Welcome to Finley Invest. Here's the thing most comparisons get wrong from the very beginning. They treat real estate and stocks as if they're competing products on a shelf, like you're choosing between two laptops with different specs. You compare the price, you compare the features, you pick the better one, and you move on. But that's not what this decision actually is. This is a decision about how you want your money to work, and more importantly, how much of your life you're willing to wrap around it. Because one of these paths asks something of you that the other one doesn't. And that difference matters enormously when you're living it at 11 p.m. on a Tuesday, and a tenant is calling because the water heater stopped working. The other mistake people make is looking at headline numbers. Someone says, my property went from $200,000 to $400,000 in 15 years, and that sounds incredible, and in some ways it is. But the headline number doesn't include what you spent maintaining that property. It doesn't include the months it sat empty. It doesn't include the taxes, the insurance, the roof replacement, or the Saturday afternoons you gave up dealing with it. The same distortion happens on the stock side. People look at a long-term index fund chart and say, well, historically the market returns around 10% annually. And again, that's true in a broad sense. But it glosses over the years where your portfolio dropped 35%, and every instinct in your body was telling you to pull out. Both investments are real. Both can genuinely build wealth. But neither of them works the way the simplified version suggests. So let's actually look at what each one involves. Not as a pitch, but as an honest account of what you're signing up for. Let's start with real estate, and let's use that $50,000 you saved. In most markets, $50,000 functions as a down payment on a property worth around $250,000. That's the part that makes real estate genuinely powerful. You're not buying a $50,000 asset. You're controlling a $250,000 asset with $50,000 of your own money. The bank covers the rest, and that's called leverage. Now, if that property appreciates, let's say conservatively at around 4% per year, after 20 years, that $250,000 property is worth somewhere in the range of $550,000. You've paid down a significant portion of the mortgage. Your equity, the portion you actually own, has grown substantially. On paper, that looks extraordinary. But here's where we have to slow down and add the parts the headline skips. That property doesn't sit still while it appreciates. It costs money to exist. Property taxes in most areas run between 1 and 2% of the home's value annually. Insurance is another recurring cost. And then there's maintenance. The general rule most experienced landlords use is to budget between 1 and 2% of the property's value per year for upkeep. That's before anything major breaks. When something major breaks, and over 20 years, something always does, you're looking at a roof replacement, an HVAC system, a plumbing issue, a structural repair. These aren't small numbers. A roof alone can run $10,000 to $15,000. An HVAC system can be similar. And then there's vacancy. Every month your property sits empty isn't just a month without income. It's a month where you're still paying the mortgage, the taxes, the insurance, and potentially the cost of cleaning and relisting. Experienced investors factor in 1 to 2 months of vacancy per year when calculating realistic returns. Most beginners don't think about that at all until it happens. When you strip all of that out of your gross rental income, and you're honest about what you actually clear, your real net return looks meaningfully different from the number people lead with in conversations. And then, there's the time. Real estate, when you're managing it yourself, is a part-time job. Not every week, but consistently enough that it's never really off your mind. Tenant issues, maintenance coordination, lease renewals, local regulations, emergency calls. None of that is catastrophic on its own, but it accumulates. Over 20 years, that's a significant portion of your life's bandwidth, being quietly occupied. Now let's look at stocks. That same $50,000 invested in a broad index fund, something that tracks the overall market, and left alone for 20 years, with no additional contributions, at a historical average return of roughly 7% after accounting for inflation, grows to somewhere around $190,000 to $200,000. Add monthly contributions, even modest ones, say $300 a month, and that number climbs considerably higher. Over 20 years, with contributions, you're looking at total wealth in a similar range to what the real estate path produces, without leverage. The mechanism here is completely different. With stocks, you're not using the bank's money to amplify your returns. You're relying on time and compounding. The growth starts slow, almost frustratingly slow in the early years. But somewhere in the second decade, something shifts. The gains begin generating their own gains. The curve that looked flat starts bending upward, in a way that feels almost disproportionate to the effort you've put in. Because the effort, frankly, is almost zero. Once the money is invested, you don't manage it. There are no phone calls, and no repairs, and no tenants, and no Saturday emergencies. The investment operates without you, and that invisibility is both its greatest strength and its greatest psychological challenge. Because the market moves, sometimes violently. There will be periods where you open your account and your portfolio has dropped 25%, 30%, maybe more. And nothing about that feels theoretical when you're living it. The instinct to do something, to protect yourself, is completely natural. But acting on that instinct is almost always the wrong move. The people who stayed invested through every major downturn of the last 50 years came out significantly ahead of those who didn't. That kind of patience is genuinely hard. It requires a level of psychological stillness that most people underestimate when they're imagining their future selves. So here's the question that actually matters, and it's not which one makes more money. It's what kind of investor are you, honestly? Because after 20 years, if you run both scenarios carefully and honestly, the financial outcomes are closer than most people expect. Both paths, done consistently and intelligently, can bring you to a similar destination in terms of net worth. The math doesn't point overwhelmingly in one direction. What the math does reveal is that the difference isn't just in the return, it's in what you have to give to get there. Real estate asks for your time, your attention, your tolerance for complexity, and a certain comfort with being a problem solver on someone else's timeline. In exchange, it gives you leverage, tax advantages that are genuinely significant, things like depreciation deductions, and the ability to defer capital gains taxes through certain legal structures, and a tangible, physical asset you can see and touch. Stocks ask for your patience, your psychological steadiness, and your willingness to watch numbers move without reacting. In exchange, they give you complete liquidity, zero management responsibility, and the quiet power of compounding working on your behalf around the clock. Neither one is the objectively correct answer. What changes the equation is you, your personality, your lifestyle, your capacity for stress, and how you actually want to spend the next 20 years. The real estate investor who hates dealing with people and emergencies will burn out. The index fund investor who can't stomach market drops will panic sell at the worst possible moment. Both of those outcomes erase the mathematical advantage of the investment entirely. This is the piece that almost every comparison misses. The best investment isn't the one with the highest theoretical return. It's the one you can stay inside long enough for it to actually work. So what does this actually mean if you're holding that $50,000 right now? The first thing worth doing is being honest, genuinely honest, about your temperament. Not what sounds impressive to say, not what a mentor or a podcast told you to prefer, but what you actually have the bandwidth for right now. If your life is already demanding, adding a rental property may compound your stress in ways that are hard to predict until you're inside it. If you go the real estate route, understand that the math only works if you account for everything up front. Before you buy, run the numbers with a full vacancy assumption, a full maintenance reserve, and realistic expenses. If the property only works financially in a best-case scenario, it probably doesn't actually work. If you go the index fund route, the single most important decision you'll make isn't which fund. It's setting up automatic contributions and then genuinely leaving it alone. Not checking it weekly. Not reacting to headlines. The psychological discipline required is real, and it's worth preparing for, rather than assuming you'll handle it naturally. There's also a third option that more people land on over time. Not as a compromise, but as a genuine strategy. Some investors use index funds as their primary passive base, and add real estate selectively, when the right property in the right market presents itself, and the numbers work without optimism. That balance means your wealth isn't entirely dependent on either path performing perfectly. And one more thing, because it gets left out of almost every comparison. The tax dimension of real estate is real and meaningful. Depreciation allows you to offset income on paper, even when your property is cash flowing positively. Certain exchange structures allow you to roll gains into new properties without an immediate tax event. These aren't loopholes. They're built into the system, and understanding them is part of understanding the actual return. None of this is financial advice. These are concepts worth exploring with a professional who understands your specific situation. But being aware they exist is the starting point. I think most people come to this question, real estate or stocks, expecting a clear answer. Something definitive. A number that ends the debate. And I understand that impulse. When you've worked hard to save money and you want to do something meaningful with it, the uncertainty is uncomfortable. You want someone to just tell you what to do. But the longer I've thought about this, the more I believe the right question isn't which one is better. It's which one can you commit to, honestly, sustainably, over a long enough time for the math to actually do its job. Wealth, in most cases, isn't built in a single dramatic decision. It's built in the thousands of ordinary days that follow. The days where you don't touch the investment, where you absorb the setback and keep going, where you stay consistent when the outcome isn't visible yet. That's true whether you're a landlord or an index fund investor. The asset matters less than the behavior you bring to it. If you're at the beginning of this journey, the most important thing you can do right now isn't to pick the perfect vehicle. It's to start and to pick something you can actually stay with. That is more valuable than any spreadsheet. If this gave you some clarity, or at least made the question feel a little less overwhelming, that's the goal. Take your time with it. You're not behind. And the fact that you're asking the question at all already puts you somewhere most people never get to. I'm Finn. I'll see you in the next one.